All right, what's up, guys? I got a web page here that I used to look at a while ago that I kind of had forgotten about. But I actually believe that hidden in Thomas Bulkowski's analyses of many stocks and their trends and a lot of statistics about them, there is a actually quite large edge hidden in the data. And so what I'm going to do is reveal that to you today. So what he did was he took 562 stocks and captured or analyzed data from about halfway through 1996 through halfway through to halfway through 2008, and that covers two bull markets, one big bear market, and then the start of another big bear market. So you're going to get a lot of variance in it. So you're going to see, like, I wish he had done this for a much larger range of data than just 12 years, but 12 years isn't bad. That's better than a lot of data that most traders try to gather. Personally, I would try to say it would be better to go back as far as you can, but 12 years is pretty good. I personally do wish this was updated, though, up till at least till last year to see how relevant it is still. So one disclaimer about this is I don't know if this data is exactly the same now, the statistics, but I will step out and make a little bit of an assumption that it's probably not that different from back then. There may be a little bit less of an edge, but I don't think the edge is completely gone. Okay, so what he did is he found that when you have a stock that, now he took the data points at the first day and the last day of each month, so he didn't just do this on every single day. Okay, however, I do believe that the first and last of the month aren't very there's something that's special about that in most cases, so I bet this could work on any day of the week, on any week of the month. But if you really want to follow his, try to be safe about it, you would only enter positions on the first, basically the second day of each month. Okay, but what he found was that when you do pick a stock that is down on its 1 month look back, down on its 3 month look back, and down on its 1 year look back, he found that those stocks that were beaten down actually had the largest rise in the next 3 months. Now, they also had the largest drop in the next 3 months, but if we scroll down further, we're going to see some very interesting data. So with those same stocks that are down on the 1 month, 3 month, and the 12 month, the maximum rise in the next 3 months, 20% of those stocks, 42% of those stocks will have a 20% pop, meaning that even though they're being shorted in the long run, there's a lot of, there's a high probability of a small short squeeze occurring here and there. And so 42% of stocks that are beaten down on the 1 month, 3 month, and 1 year will have a 20% 20% pop. Okay, 58% of those stocks that are down will have a 10% drop. Okay, but if you add 58% and 42%, what does that equal? 100%, right? So now I don't think the numbers are going to be exactly perfect, because if you know how data is gathered, it's not like 100% of the stocks are either the 42% that jumped 20% or the 58% that dropped 10%, right? Some of them might drop 10% or 15%, but then end up jumping 20% in the next 3 months, right? So some of these stocks in the 58% and the 42% might actually be the same stocks, so they might not fully comprise 100%. But what I would be willing to bet is that more often than not, these stocks and these stocks are not the same. So that if you add these stocks and these stocks together, it will get close to 100%. Okay? Again, I can't prove that because he doesn't have the list of the names of stocks. But what I see here is an inefficiency to the upside. So when you take a stock that is beaten down, even though in the long run those beaten down stocks will probably continue to be beaten down until they either go bankrupt or eventually they revamp their company and they start having a change in the direction of their earnings per share. Even though those stocks will fail usually, when they're being shorted that much, they don't actually drop that quickly. They have a slow and steady downtrend. But what happens is that there are these pretty common short squeezes that occur on the way down, where a lot of short sellers will get, stopped out of their positions, which will cause buying. And so basically, when a stock is that beaten down, it's got more reward to the upside. So you've got let's just say, generally speaking, you've got a 42% chance of a 20% pop on a stock that's down, down, down on these 3-time, look backs. And you've got a 10%, or you've got a 58% chance of a 10% drop. Well, that's a 2-to-1 risk to reward with a 42% win rate, correct? Roughly speaking, I'm not saying it's exactly that, but the stats there are kind of indicating that it's something close to that probably, right? So you've got a 42% chance of a 2-to-1 winning. Well, let's see what that is. Let's say you start with a $1,000 account. You've got a 42% chance of winning, a 2-to-1 trade. The edge above break even for that is about 9%, a little bit less, but you can round up. After 100 trades, that could potentially have an 850% return. 100 more trades, you might lose some. But again, optimal F, that will happen, right? So as you can see, there's some drawdown. But in the long run, you will see that the edge is to the upside, that this is a profitable strategy, even with 9% risk. And if you're trading optimal F, again, you will lose 30% of the account, maybe 60% of the account. But then when you hit a good streak, you will way more than wipe out those losses, right? So as you can see, that's a huge edge. Now, I'm not going to go further with that, but basically, I wouldn't necessarily assume it's exactly a 9% edge, so I probably wouldn't risk a full 9%. I might risk 5%, assuming that maybe the edge is a bit smaller than that. But I believe there still is definitely an edge there. So what you want to do is, you can literally do this on Robinhood. Just pull up Robinhood, pick a stock, look back on the 1 month, the 3 month, and the 1 year on it, on just the charting. If it's red on all 3 of those, basically what you want to do is buy it with a stop loss at 10% below where you entered and a take profit at 20% above where you entered. Expect to win that about 42% of the time, and risk maybe 5% of your account per trade. And then you could do that on multiple different stocks at once. Now, another thing that I don't remember which it was, but basically he has tons of different analyses in his website and like tons of stats. But what he found was that stocks that are less than $10 tend to be the most volatile. So if you want to get as many trades as possible, meaning that you either hit that 10% stop loss or that 20% take profit, if you want to get more trades, like if you want to basically have a higher average trades per day or trades per month or trades per year, you would pick stocks that are under $10 so that you could get more trades, so you could see the edge play out faster and make more money. The only issue that you're going to run into with the stocks that are $10 and under is that bid-ask spreads can be high. So one other filter that you're going to want to look for with these stocks that you're picking that are down on the 1 month, 3 month, and 1 year is you want to make sure there's only a 1 cent bid-ask spread, right? So if the stock is trading at $6.62, you want to make sure that the bid is $6.61 and that the ask is $6.62, right? Or $6.63, right? You want like a 1-2 cent bid-ask spread, because if you have to buy the ask, then that's eating into your edge, correct? So obviously, when you're doing this, you want to be using limit orders for your entries, possibly limit orders for your exits. Again, so you don't have to pick sub $10 stocks, okay? Because this data includes stocks that are probably $3 all the way up to stocks that are hundreds of dollars, right? But just know that obviously you're going to see that volatility play out, and your trades are going to win or lose much faster if you pick low-priced stocks, which means that you get to do this more and more, build up an account size. So yeah, just make sure that your bid-ask spreads are good. So don't pick a stock that's got like a 30 cent bid-ask spread, right? That's not liquid enough to trade, and you won't get a good fill on it if you're market ordering. I mean, you could, if you want to try to do a limit order, that's fine, but you might not ever get filled, right? So pick liquid stocks, but try to look for low-priced liquid stocks that have high volume, basically, and buy them when they're beaten down, looking for a 20% profit or 20% up move from where you entered the position at. And I would say risk maybe about, well, risk as much as you want or as little as you want. I would say risk no more than 9%. 8% is probably safer. But based on the fact that this data is old, I would say maybe tone it down to less than 5% risk. Okay, not financial advice, but I hope this helps you guys out. Let me do some visual examples of this for people who are, sorry, I just have a paper trade on. I'm practicing some patterns and stuff. But so here, I think this might be a perfect example. Let's see, what do I got? Yeah, so, oh no, this is my Coolamaji setup. So I don't know why it hasn't saved my new one, but what you would want to do is go like, only look at stocks, change 1 month below 0, change 3 months below 0. You would want to do yearly performance below 0. You'd want to do price below, I don't know, just say $11, $10, $11, whatever. I don't think there's a way to filter by bid-ask spreads on here. But basically then what it's going to do is pull up a lot of stocks that you're going to want to look at, and you just pick one. And then what you're going to see, well, this one, well, you can do this one if you want. The volatility is very interesting. Hold on, so, I mean, this will give you a chance to look at different stocks. I don't know that I would pick this one. This looks very interesting, but I mean, you could. Technically, this kind of pattern or whatever is you know, something like this may have been in his data. It won't be that exact stock, obviously, but if you just look through stocks that are beaten down, what you'll find is that, of course, this stock, this is not a long-term investment stock. As you can see, it's basically going out of business, right? But what you're betting on is that even though it trends down, that there's these short squeezes that happen, and basically at any given point when it's really downtrended like this, it's due for a short squeeze. And so what you can see is one actually just happened where it definitely moved over 20%, which is that at this point it was down on the yearly, 1 month, and 3 month, obviously, right? If you just look back. And so if you'd been buying anywhere around here, I mean, you might have gotten stopped out if you were buying like here or whatever. But it's very likely that you'll catch a pop like this where it goes up. Or if you were buying here, then boom, it gaps up on the open, you would sell, right? One issue you could run into, obviously, like any trading strategy when it comes to stocks, is that there's it's not it's not open as frequently as futures markets, right? So it can gap up or gap down at the open and gap past your take profit, which would be good for you, but it also could gap below your stop loss, which would be bad for you, right? But I would guess that in the long run, it will basically even out, so that won't matter too much. But in the short run, it could hurt you a little bit. But in the long run, it will all balance out. But anyway, so if you just look through stocks, where it does that, again, this doesn't look entirely that liquid, but as you can see, a stock that is beaten down like this has these short squeeze pops where it goes up way more than 20%, right? But on average, 42% of stocks that are beaten down will have a 20% pop within 3 months, that are beaten down on those 3 lookbacks that I told you. And so it actually becomes very clear to you when you actually look into the data. You might be scared to like buy this stock because it's so beaten down, but you just look at all those short squeezes that occur. This is actually a great stock to buy for a 20% up move with a 10% stop loss. Or maybe you do your own data research and you'll find more optimal profit target and stop loss results. But you can see everywhere, like even like this day, that's over 20% gain. This right here is over a 20% gain, I believe. That's way more than 20% gain. So as you can see, there's tons of short squeezes. So you might see this and think, oh, well, this should be shorted. And in the long run, maybe that's true. But the real edge, the funny thing is that the edge in these stocks is that they have short squeezes frequently. And so that's where the edge is. So anyway, I hope this helps you out. The last one that I actually traded with real funds was Globe Life. I don't know if you've heard of this company, but basically I bought it on like this day or this day, caught a 20% pop, and I sold my position. If you don't know what Globe Life is, it's basically a life insurance sales company. And I actually applied to work at this company at one point when I was like looking for a job, like struggling to look for a job. It was probably a little over 2 years ago, and I got interviewed by, you know, their whatever the hiring manager guy who I got assigned to was, and they actually didn't hire me because I asked them too many questions. Because during the interview, like I talked a little bit about myself, but then he said, "Do you have any questions?" And I started asking some like a little bit of hard questions about the company, because before the interview, I had looked at the company and I was like, this company doesn't seem legit. And I heard a lot of people talking about how they felt like they were scammed by Globe Life Insurance. And this was sometime around here where I had that interview. And obviously the company did decently well after that point for a while, but just recently, about a month ago, I think it was. Or no, it was actually, no, this month. But see, this is where you know there's insider trading going on, because this started happening right before the news dropped. But basically on this day, it came out that apparently they are committing fraud and stuff, and they apparently have fraudulent practices, which to me was completely obvious when I got interviewed by them. But anyway, it took a long time for the market to actually price that in. But once it did, boom, it flushed. But here's the thing, again, after a giant down day like this, where's the edge, right? Should you short this stock? According to Thomas Bukowski, no. And so what I did is I bought it here or here, and I sold for a 20% gain on the stock at some point. I can't remember the exact price, but I think I bought it on this day. But it may have been this day. I'm not sure, but I think it was this day. But anyway, I caught an up move, and within a couple days later, I sold my position for a 20% profit on the move of the stock, right? So the reason I did that was because it followed the criteria. Because basically, just because of this one bad news coming out, it fell into this kind of stock, right? Now it's down on the 1 year, the 3 months, and the 1 month. So technically it falls under this criteria. So to me, I was like, hey, I'll give it a shot. It worked out. So there's something to be said about that, right? So anyway, I hope this helps you guys out. Take care, and I'll see you next time.